Hello, and we will now continue our industrial technology conference with a heavyweight in this industry, GEA Group, which is a DAX member, and the company will be presented by Eduard Biller, who's manager of investor relation. Format as with all the others, 20 minutes presentation, roughly 10 minutes Q&A, chat box for questions. We will record this event and then post it on Research Hub a little later today. If you have any questions, feel free to post them. And I will now hand it over to Eduard for his insights. Please go ahead.
Thank you. Hello, everybody, and thank you for the interest in the company. I've been here already the year before. It was a very good event, so we're more than happy to do a recap, basically, and talk about how the company developed since in last year and since the last meeting, basically. So let's start with the overview, how GEA is, or how big it actually is. I mean, last year we had 5.5 billion in revenue and a profitability margin of 16.5% as a percentage of sales. Going forward, we want to push these numbers even further. So targets up until 2030 will be to achieve sales of more than 7 billion and a profitability margin of 17 to 19%. Let's start with first things first. Some of you may know the company, some of you may not know the company. What does the company actually do? We are a provider of equipment or processing lines, mainly focusing on the food, beverage, and pharmaceutical industries. As you can see in the middle, 1/4 of processed milk comes from dairy production systems. So dairy is like roughly 1/3 of our total sales, either in the dairy farming sector or dairy processing sector. So if you're buying your Weinstefan Milch, Bergland Milch, if you're in Germany or any other milk in Europe or basically worldwide, if you buy 4 liters of milk, one of them will be basically done on our machines. We're also pretty strong, for example, in spaghetti processing. Every 4th spaghetti package comes from our machines, meaning if you're buying Barilla spaghetti or pasta, they're a customer of ours, it's already public. You can be pretty sure that it came from our machines. We're also pretty strong, for example, in cookies. If you're familiar with the Oreo cookie from Mondelez, or with the Ferrero cookie, or with the Kinderini cookies that are now basically in every supermarket, they've all been tried and tested and developed with our machines, and we sold process lines for them also. So if you're buying the Ferrero cookie in the US, it came from our machines, and also the ones in Europe and the ones in Asia as well. And we're also pretty strong in the pharmaceutical equipment. What we do here is, for example, tablet presses. So if you're buying painkillers like Ratiopharm or ibuprofen or something similar, it might be the case that the tablets come from our machines, but our focus here is also a little bit different. For example, we're pretty strong in the cancer treatment with tablet presses. As you can see it on the right corner below, every second tablet to treat cancer is made in our equipment. We also produce other equipment here, for example, pharmaceutical separators. We also source our equipment to laboratories or R&D departments of Pfizer, of Merck, and help them develop new treatments, basically, for all types of diseases. Coming to the next slide. Last year, we had a very similar slide presented here, but it was with 5 divisions instead of 4. What happened here? We didn't sell anything. We did just restructure it, meaning in the past we had a heating and refrigeration technologies division that was made up of 2 parts, the components business and the processing business, basically, so entire lines. And what we did is we broke it off. The components business went to separation and flow technologies, which is now called pure flow processing. And the process lines went into liquid and powder technologies, which is now combined, called nutrition plant engineering. Why did we do that? The solution is basically really simple. They were targeting the same customers. The discussions were very similar, so it made sense to put them basically together. So now we have 4 divisions: pure flow processing. This is the components business we're having, roughly 2 billion of sales with an EBITDA margin of upper tweens, basically. We have nutrition plant engineering. This is our processing business, meaning if you want to build a new facility for dairy powder processing, for a brewery, or anything else that involves basically an entire process line made from the ground up, these are the guys that they're talking to. Nutrition plant engineering has a very similar sales figure as pure flow processing, namely 2 billion. But the profitability margin here, as you can see, is way lower. Why is that the case? On the one hand, the service share is lower due to the type of the business. And also here we are sourcing third-party equipment in, and you can't put your own margin on equipment that you're sourcing. For example, if we're building a facility for dairy or for beverages, we buy piping and tubing. This is not our specialty. This is not that complicated to make them. So we source them in, and the customer knows exactly what the price for the pipes and the tubes is. So it's a little bit dilutive in that sense, but it makes sense because with this large facilities that we're building, for each order, we're getting relatively big down payments, varying between 10 to 30% of the total order value, basically. So this division is run basically with negative capital employed because all the down payments help us finance the business. Pharma and food applications is actually the same as it was last year. Back then it was called Food and Healthcare Technologies. It was just a name change, and pharma was put up front, because we also see more opportunities in pharma in general. Pharma here makes up like 20% of total sales of the business. So if you take just 1 billion of sales as an example, roughly 200, a little bit more than 200 million is done with pharmaceutical equipment, and the rest is then done with cookies, with pasta, with chicken nuggets, for example, all these types of equipment. And the last business that we're having that's a little bit different, it's farm technologies, meaning the first three businesses that I discussed, this is a B2B business, meaning we're discussing it here with the with procurement people from Danone, from Coca-Cola, Heineken, whosoever. And the farm technologies business is a little bit different route to market here, because here we're using dealers to sell our equipment to all the dairy farmers in Canada, in the US, in Germany, Netherlands, you name it, basically. This business is a little bit different than the other three, as I said before. Nevertheless, it's still a highly profitable business and growing. If you look at the sales figures, it's 750 million already, and the profitability margin is basically a 15, and we're targeting here even higher figures in 2030, which we'll discuss later on. How does our company look like regarding our customer base? As I said before, everybody knows our customers, as you can imagine, the Coca-Cola, PepsiCo, Nestle, Danone, and so on. What's more interesting for us is, even though all these names are our customers, and they might be somewhere in the top 10 customers or top 50 customers, depending who's buying the largest piece of equipment this year. But we also have a wide variety of mom and pop shops, basically companies that you've never heard of because they're not listed, but who are also producing either cookies or other goods. And all of the customers are basically recurring. In the year one, you're buying our new machine or new processing line, and you are somewhere in the top 10, top 50. In the next couple of years, you buy our service equipment, meaning, for example, if electrical engine breaks down, if the piping breaks down, you buy it again from us, but you're then somewhere in the top 200, top 300 customers. Just to give you an idea how many customers do we actually have. If you would open the Excel sheet with all the names of the customers, somewhere around 4,000 rows should be a finish. We are also regionally balanced, meaning even though the North America and US is the largest single market for us, 18 to 19% is US only. If you look at it worldwide, we're actually pretty much diversified here. I mean, we're a German company. We have a pretty strong European focus with close to 50%. But if you look at the growing figures here, we see growth coming also out of Europe, namely, for example, India, China, but also in the US. We're also pretty strong regarding sustainability. And sustainability for us is not only the rainbow flags outside, but for us, it means really total cost of ownership for our customers. How can we help them save energy? Because you can think about it this way: in the dairy business or in the food processing business, you usually have to heat something up or cool something down. For example, if you look at cookies, you have your bakery oven just a little bit bigger than yours at home. If you have milk, you need to cool it down to basically 4 degrees. And I mean, we're talking about industrial scale figures here. You just need, for example, then our heat pumps or our compressors. And since we either made the original equipment ourselves and the plant is already there, we can retrofit our heat pumps in there and save energy, as you can see, for example, with Heineken. Or we can also build you the entirely new plant if you are talking about a greenfield project. And the idea here is, even though the equipment is then more expensive than it would be without the heat pump, the total cost of ownership for the next 10 to 20 years will be significantly below the ones if you would buy it without the heat pump. Because on average, our equipment lasts 20 years, and this is just the average. If you would look at some of our dairy separators that we sold, they are already 30 years old and they're still running. They just need the service and maintenance, and the machines will run basically for the next 30 to 40 years without problems. Coming to the next topic, just a second. Just want to open the next slide. So our plan to continue growing is called Mission 30, and 30 because it's supposed to last until 2030. The idea here is we want to grow the company with more than 5% on average. Last year, we grew it by 3.7%. But this year we're targeting 5 to 7% organic sales growth, and the more than 5% is just then the CAGR. So year one was a little bit weaker, but if we look at the figures from this year, we have an order backlog that is actually a record high with 3.5 billion. And the pipeline is also pretty good, so we're pretty confident that we can achieve the figures. Looking at profitability, last year we had a profitability figure of EBITDA before restructuring of 16.5%. And our goal is to grow this figure to 17 to 19% EBITDA margin without any adjustments, just your normal textbook figures basically. And the last figure that we're having is we want to grow ROCE to more than 45%. Last year it was 36.2%. So then again, higher profitability, more efficient use of the capital employed, hence you get the more than 45% figure. How did we do it last year? We increased our share of sustainable solutions. We achieved already a 45.7% of total sales. The heat pumps that I've mentioned before with Heineken or with Arla, they go directly into these sustainable solutions, for example, or also other pieces of business. It's either, for example, saving energy, saving water. All these contribute to sustainable solutions sales share. Another topic for us is we want to grow service sales to basically 2.9 billion. So almost 3 billion will be, of the 7 billion will be service. Last year we had 2.2 billion basically. So we want to grow this in absolute terms by 700 million. That is the room to go. New food is also an ongoing topic for us, meaning our idea is to grow protein not necessarily from the chicken or in the cow, but rather, for example, in a fermenter, basically. And the idea here is it's way easier, and if you scale it up industrial-wise, it's also cheaper to grow protein this way instead of killing cows, killing chickens, and so on. Here we want to achieve more than 400 million order intake by 2030. Last year we had roughly 70 million order intake, so there's still more room to grow. We also have some technologies that are growing way stronger than others, and we named them above average growing verticals. Automated milking equipment, for example, is such a vertical, or also heat pumps, the ones that I've showed before also. And we saw more than 30% order intake growth in last year. I mean, this was an exceptional year. Don't expect it to grow every year by more than 30%, but we're just seeing a good and healthy demand, especially coming for the energy efficient solutions. We also want to increase our digital sales. I mean, we're a mechanical equipment manufacturer here, but the idea is all of our equipment can be retrofitted with sensors, and we can sell you software to make the equipment more efficient. The idea here is to grow it to more than 200 million by 2030. Last year, we achieved roughly 80 million already. And the digital sales go directly into the service sales share, basically, and service sales in general. So the 700 million growth in service, roughly 120, 130 million should come out of digital sales, basically. And the last topic here, how we want to achieve that, is our vitality index. So vitality index means equipment no older than 5 years. And our goal is here to achieve basically 30%. So every third piece a piece of equipment should be no older than 5 years that we are selling. And the more modern the equipment is, usually the more energy efficient it is, or also, for example, more automated. Now coming to the next topic of profitability, how are we going to achieve 17 to 19%? First things first, we will be obviously sell more equipment and also higher service share. But we also have a couple of initiatives going on that are basically in our hand, because sell more equipment is also depending on the customers. But for example, the COGS savings here with the 120 million, they are entirely in our hand. Just to give you an idea, how can we save on COGS? GEA has more suppliers and we does have employees, and we have roughly 19,000 employees. So if you put the procurement volume on less hands, basically, you can negotiate better prices. The goal here is to save 120 million in EBITDA contribution, and this should be a more or less linear development. So last year we achieved a little bit more than 20 million, but this year we're targeting then again around 20 million in savings. The next topic is here the G&A ratio. GEA has a relatively normal sales ratio to sales, basically, but the G&A ratio is relatively high when we compare it to peers. So our goal is here to save roughly 100 million. Last year was basically zero. With our reorganization of the business, we're targeting 10 to 15 million this year, and then again further 10 million in 2027. So this will be more back-end loaded. As you can imagine, that 28, 29, and 2030 should get the lion's share of the 100 million savings. Okay, coming now, what do we do basically with our money that the company is earning? First of all, obviously, we invest into our own facilities. Currently, the level is a little bit more elevated. So this year should be slightly above 4% of sales will go into CapEx. Our goal here is to lower this figure to 2.5% to 3%. So if you think about it, by 2030, roughly 7 billion of sales, around 3% CapEx of sales, so somewhere around 200 million. This should be the ideal figure. What we're also doing is generate a lot of cash flow, basically, free cash flow. So our target for this year should be similar to 2025. And our goal is from the year 2024 up until 2030 to generate more than 4 billion of free cash flow. So we achieved already 1 billion in 24 and 25. So we have more than 3 billion to achieve over 5 years, basically. This gives you a rough indication. We're also paying high growing dividends, basically, and we're also looking for M&A. Honestly, so far in the last 6 years, the company did only 2 M&A deals. And if you aggregate the sales figure, it should be somewhere in the low millions, basically. So the company is also looking at share buybacks in general. Over the past years, the company executed 2 share buybacks with roughly 700 million and bought back the shares and canceled them. And as you can see it on the upper side here, we did grow our dividend by 15% from 23 to 24, and by further 15 cents in 25. And the goal here is to basically distribute half of the net profit to US shareholders as dividends. I mean, the shareholder return speaks for itself. It has been, I mean, the last couple of months have been a little bit weaker because honestly, our business is steadily growing. We're not a SpaceX, we're not an Anthropic. So our gut feeling is that institutional investors made room for other higher growing businesses, but the weak share performance of the last couple of months basically had nothing to do with operational performance. If anything, we actually grew the business further, and also our management, when the share price was relatively weak, they bought back shares themselves. So their own money basically, and not the ones that they have to buy back with their bonus, for example, but rather they just invested into the company because they know of the value of the company. Overall, the figure was roughly 20,000 shares that have been bought back, 11,000 by our CEO, Stefan Klebert, who now owns 111,000 shares. And the rest was then bought back by his colleagues in the management. Looking at the time, I think we should start with the questions. I hope this gave you a little bit of an overview of the business.
I think it was an excellent overview, Eduard. Thanks so much for the insights that you shared. And when I look at the questions, a lot of the questions you've already touched during your presentation. So I think we can there be rather brief, starting out with the whey protein extraction. You talked about your growing protein business. Question reads, do you have equipment solutions for whey protein extraction and processing in your portfolio? What's the earnings impact of these systems? You've already touched on that, maybe just 1 or 2 sentences on that.
I mean, if you're interested in protein, we're actually the company to go to. We can make it both on the liquid dairy side, but if you're discussing whey protein as a company like ESN is selling, or Body Lab 24, or you name it, if you talk about whey powder, we're actually your go-to guy. That doesn't necessarily mean that we get orders every single quarter here, because if it's a new facility, this can be a little bit more lumpy. But I mean, my best guess is if you're using protein powder in your protein shake, the chances are pretty good that this came from our equipment.
Great, thank you. Let's start talking about the pharma business. And the question reads, we're seeing cautious CapEx spending in the pharma healthcare industry, as well as America First relocation trends towards the US. Does this also affect your company? And what signals are you currently receiving from your pharma customers?
Pharma was a little bit weaker in Q1 and H1 in general this year, but this is something also of a seasonality. So far, if our customers are discussing relocation plans, for us, it's actually really interesting, because if you're building a new facility, you are supposed to use the newest equipment that is out there. And here we can sell our customers, for example, continuous tablet presses. The idea here is to go away from the batch processing, as is done, for example, with your own cookies at home. You make a batch of cookies, like 12 cookies, and that's it. And you have to wait until the next batch is done. And with the continuous tablet presses, is something that we've built ourselves, and we tested it already with Pfizer, for example. It's well-known American pharmaceutical company, where you can see that you can go way sooner into the market with your product. You need less people to make the tablets, for example. So for us, if there's some sort of relocation and a new plant that is going to be built, for us, it's actually a good thing.
Great, thank you. Talking about second half 2026, What upside or downside risks are you seeing towards the second half in your guidance? And maybe as a follow-up in combination, are you seeing volume softening in order intake momentum, or is the pipeline rather stabilizing?
The pipeline was already stable before, and the pipeline so far is actually pretty good. If you talk about our business, we have three income streams, basically. The service business, this is more of a recurring revenue business. So our machines have a certain time frame that they're operating, and after a certain number of hours, they need to be replaced or at least serviced. So this is a given, more or less. The equipment business is looking good. So these are the single pieces of equipment that we're selling. And we also have these large orders, for example. This is the ones that that are the most difficult to predict. The pipeline is good, especially with these large orders. Only the timing is a problem. If you can remember, we discussed the Baladna order last year already when we got the order in August. The problem or the difference was just we got the down payment in October. So it was booked in Q4 then, even though we signed it in Q3. And our CEO, Stefan Klebert, he made the handshake deal already 1 year prior with the head of Baladna. So it took us 1.5 years basically to go from handshake agreement with the boss of the company to really booking the order. So downside so far is if one customer pushes his down payment instead of the 25th of December to 10th of January, an order might be postponed basically to Q1 27. But this is like the only risk that is out there. And honestly, for us, it's also not a real risk because we know our best guess is if we can get the order or not. It's just our problem to get the timing right. So you saw it already in Q4. Last year, we got plenty of large orders. It was even more than we expected ourselves. But if the customer is signing, we are the last people to tell them, please don't sign it yet. We want to push it in the next quarter, since customer is king. So the upside here is, it's really depending how the conflict in Iran is continuing to go. For example, our equipment, the newest equipment that we're selling is more energy efficient. So for us, it's actually a good thing if the energy prices are high. And ourselves, we spend less than 30 million in total on energy. So we are a relatively energy poor company so far. But our customers are very energy intensive. So for us, high energy prices are good, actually.
Great. Looking at the clock, we have 1 minute, so I'm going to skip the question regarding your use of cash because we've discussed that already, M&A, dividends, or buybacks. One last question, which I think can be answered quite quickly, is regarding insider purchases. We've seen quite a bit of those. And given that conviction, would it make sense to be more aggressive on the share buyback side?
Might make sense. It's just our company is also really looking into M&A so far. If you just need to remind you, we have a slight cash balance by the end of Q1 this year. In Q2, we spent roughly 210 million of our own money on the dividend. So it's really tough to tell if we're going to be cash positive or slightly cash negative by the end of Q2. But looking forward, if the share price is continuing to be weak and we have a positive cash balance, management will definitely consider the share buyback as an option.
Great. Thank you so much. We are unfortunately out of time, on the nose, 3:30. Thanks so much, Edward. Thanks so much for everybody who joined us, for your interest and, of course, the great questions. We will continue with Gevorkian, and I just put the direct link to that next meeting in the chat box. Feel free to just click it and join the next meeting. And have fun. I'll see you all again with Cronus in about half an hour.
Thank you. Bye.